Thank you, thank you, and thank you. Now, let me share this information with us. This webinar, because we have more than 500 registered participants, is live on YouTube again. So you can join through the Zoom. You can join our YouTube channel. Meanwhile, I will hand over to the chairperson of this faculty, Mrs. Tomi Adepoju, FCA, the partner KPMG, and chairperson of ESG faculty. Over to you, ma'am, for opening remarks.
Thank you very much, sir. Good morning, everybody, and welcome to our very first webinar in this new faculty. It's a pleasure to have you all here, and we do believe that we are all going to leave here today with very good, deeper knowledge of what ESG and sustainability means for the way we run our business. I will just give a very brief opening remark, and then we would introduce the speakers that we have put together for today to then make their presentation. And I'm sure when a number of us saw the topic, we may have asked ourselves, why this topic? What exactly is the linkage between ESG and the way we do business, the ethical way we do business, and every other thing? And for us, it became very important because as we look at the term environmental, social, and governance, which is a term that has become more than a cliche that people use. It's a term that's come to stay with us, and it's gained traction even in the way the world is operating, whether from an investment point of view, from a corporate governance point of view, from the way we run our business. ESG has come to stay. It's become a framework that investors are using, regulators are using to evaluate the sustainability and the ethical impact of an organization. And so that's why it's important for us to be able to have a deeper understanding of what we are trying to get into. And after this particular webinar, we will have many more webinars and even certification courses that we believe will help our members to be able to hone their skills in this particular area. So at this point, I will just invite Mr. Abiodun Shorunke to introduce the panelists for today, and then we will take the presentation. Thereafter, we'll go into a brief question and answer session. Thank you.
Thank you very much, Madam Chairman. Our first presenter will be Mr. Babajide Ivironke, and I'll read out his citation as follows. Babajide is an accomplished strategic business leader, futurist, and award-winning chief financial officer, equipped with distinguished track records in executive and finance leadership roles, garnered for over 2 decades from academics, banking, and non-bank financial institutions, healthcare, manufacturing, bellwether FMCG, and energy sectors. Is a fiscally conscious and goal-driven executive with areas of expertise that spans audit, climate and energy finance, including sustainable energy, treasury and financial management, corporate and development finance, with proven track record in M&A and deals structuring, arranging complex first-in-kind transactions, as well as both the raising and deployment of capital, equity, mezzanine, and debt, strategic business reporting, taxation, budgeting, and general administration. His love for developing talent and imparting knowledge makes him a well sought after facilitator by various professional bodies and organizations such as ACCA Global and Region, ICAN and ANAN for their continuous professional development programs, CPDs. Babajide was the CFO at Abuja Electricity Distribution Company, PLC, AEDC, until November 2024. And prior to joining AEDC, he was the group CFO at Viatan, a leading integrated power and gas company, providing captive and embedded energy solutions to government, commercial and industrial customers. He was a board membership of ICT and consultancy faculty, corporate reporting faculty, and electoral matters committee member of ICAN for multiple years. He was elected as chairman of ACCA Nigeria Advisory Committee in 2004 and represented Nigeria at ACCA International Assembly in UK from 2012 to 2020. When he was elected into the ACCA Global Governing Council, he recently served out his second term as an audit committee member at ACCA, as well as served as member of nominating and governance committee. Lastly, he is also a member, a board member, and the secretary of the trustees of IFRS experts in Nigeria, as well as member of Nigeria Integrated Reporting Council. He is also a member of Adoption Readiness Working Group, ARWG, for Sustainability Reporting of Financial Reporting Council of Nigeria. And that is why we brought him to this training, so that he can give us, we can tap into his wealth of experience. So at this point, I'd like to usher in our presenter for the first paper in the name of Mr. Babajide Ibironke. You have the floor, sir.
Good morning, Mr. Abiodun. Good morning, colleagues. I hope you all can hear me. Good morning, everyone. Can you hear me, please?
Loud and clear, sir.
Fantastic.
We can hear you, sir.
Fantastic. Good morning, everyone. First and foremost, I'd like to thank Madam Chair Lady, the chairperson of our, faculty, for providing this platform for all of us. And also to thank all members. As at the last time I checked, we're over 388 members who have joined this call, and that's quite very impressive, very, very interesting. So thank you to all of you. Thank you to Madam Chair Lady. And thank you to every other person that has been part of this program. My name is Babajide, as has been said earlier on. I just want to confirm also if you can see my screen. I tried to share my screen with the slides. Please confirm, Madam Chairman or Abiodun, if
Yes, we can see it.
All right, thank you so much. All right, so without much ado, I'll just go right into my presentation. We don't really have all the time. It's 10:13 and I've got just 45 minutes. Please do not hesitate to ask any question you might wish to ask as we go on. The ground rule, I'm sure you already know. It's raise up your hand and then you ask the appropriate question. And we're more than happy to take all the questions today. I will modify the topic a little bit. And so if you can see my screen, you will see that although the topic is ESG and work ethics, aligning corporate values with ESG factors, I've slightly modified it to say I'm going to be speaking around integrating sustainability into corporate culture and practices, and I would speak to that just in a moment. So I will start the entire program. If you get my agenda item, I will start by beginning with defining ESG, give you some historical background, exploring its importance alongside ethics in corporate context. It's very, very important for us to understand work ethics in a corporate context. And then next, we will delve into environmental factors, social factors, governance factors, taking all of those factors one after the other and discussing their relevance to corporate responsibility and ethical leadership. And of course, finally, I will examine how companies can then align their corporate values with ESG. So that's pretty much what I have on the agenda item this morning. So introducing ESG, right? So the term ESG, when we say ESG, we refer to environmental, social, and governance factors. And these factors rose to popular, sometimes popular use sometimes in 2005. That was when there was a publication on, by some organization, including the World Bank. It was titled "Who Cares When?" It was a UN Global Compact report that was issued with the support of 20 financial institutions. Those financial institutions have circa 6 trillion in asset under management, And since that time, many in the investment industry believe that the development of ESG factor is a consideration and it's becoming very, very inevitable. And I like the way Madam Chairman has put it earlier on, and she said in her introductory speech that it's now more than a cliche. All right. So investment companies, corporate governance issue, regulators, most of them are now beginning to use ESG to gauge ethical issues across organizations. So it is very true. And so the evidence towards relationship between consideration for ESG issues and financial performance is becoming very greater by the day. And there's been a wider recognition of the necessity of the sustainability investment. And rather than looking at just short-term, people are beginning to consider the long-term implication and what it meant for the environment, social, and corporate governance issue. And they are becoming very, important in the investment market today. So ESG has become less of a question of philanthropy than practicality. It's more of practicality today. ESG has become short-term for investment methodologies that embrace ESG and sustainability factor as a means of helping to identify companies with superior models. So I put the title of the report below this slide, and I'm happy to share the entire report together with my slide so that members can have more view on what I'm talking about here. So there's a growing evidence that suggests today that ESG factors, when they are integrated into investment analysis and portfolio construction, they may offer investors, some potential long-term performance advantages, rather than just, the cliche, and that's why I said I like the way Madam Chairman puts it earlier on. So here I try to explore the, what I can call the historical perspective to give more color to how we found ourselves where we are today. I'm happy I'm speaking to accountants. So the conceptual framework for financial reporting, as issued by the IASB, International Accounting Standard Board in 2018, March 31st, 2018, the conceptual framework was issued. It became effective 1st of January 2020. That conceptual framework identified the primary users of financial statement, right? And it says the primary users of financial statement are the investors, the lenders, and of course, other creditors. And it broke down investors into potential investors and existing investors. So increasingly, these users, right, and other stakeholders alike, they're beginning to get more interested, not only in the financial performance of the company, but also in how they balance financial return with social and environmental concern. So as a result of that, narrative reports such as social and environmental matters have gradually developed since the 1960s. So in the 60s all through 70s, you see companies trying to, compare, becoming aware of their social and environmental impact. Environmental reporting gathered pace. Through the 1980s, social reporting was added in the 1990s, and you can see that evolution, all right, up till today. So where are we today? We are now at the stage where the focus is on sustainability reporting. And this encompasses social, environmental matters, but they also focus majorly on sustainable development. So the move towards sustainability saw the United Nations, for instance, issued sustainability development goals in 2015. You remember those 17 SDGs, which was a call to action to end poverty and to protect the planet. This includes, for example, climate action, zero hunger, and reduce inequalities. And I'm happy that just over the weekend we celebrated the International Women's Day, which is also part of the diversity agenda that we're trying to promote. So you see, companies are not only required to report on the ESGs that are specifically material to it, which has to be assessed through, what we call the double materiality principle. There's a sustainability matter that is material when it meets the criteria of impact materiality as well as financial materiality as well, or even both in some cases. So before we look at the guidance on sustainability report, I just try to put this context very clearly that what we're talking about today is very important, ESG, but to also let you appreciate that ESG is a part of the bigger thing. It's a part of the sustainability reporting. And if you look at the name of this faculty, it's actually sustainability faculty, as it were, and as an overall, requirement of corporate reporting in the real sense of it. So what I tried to do this morning, ladies and gentlemen, is to put this sustainability reporting within the context of what we are discussing. And before you talk about sustainability reporting, you must talk about sustainability as a concept. So sustainability, maybe I should put it this way. When you say a sustainable business, what does it mean? All right. So a sustainable business means that you want to run that same business, right? You want to run your business today in such a way that will meet the need of the present world without compromising the ability of the future generation to meet their own need. So when a company says we are publishing sustainability reports, what they are even telling you, in essence, is that they are publishing a report that shows a report that shows not just the economic, but the environmental, social, and governance, and depicts the performances and the objectives that they have set for themselves, and how they are thriving, and how they are achieving those objectives, at any given point in time. So a sustainable business meets the needs of the present world without compromising the ability of the future generation to meet their own need. All right. So we need to then begin to, and immediately this program was sent out, I've seen quite a number of our members reaching out to me to say, oh, they thought that sustainability means ESG. I mean, somebody called me yesterday and said, what he would like to learn about this, what he would like to take away from this session, is to actually understand the difference between ESG report and sustainability report. So immediately he said that, I quickly went back to amend my slide a little bit to take care of his own concern. I mean, because also a member and he wants to know. So what I've tried to do today, or what I would try to do, what I've tried to do with this presentation is to tweak it a bit based on the information that I've gotten from our members. So members, if you are here, your name is Mr. Sheung. Apologies, I'm mentioning your name in public. You have said to me that you wanted to know the difference between sustainability report and ESG report. So I want to tell you, Sheung, that sustainability report is a report that shows performance and objectives that an organization has set for itself and how it's tracking those for around economic, environmental, social, and governance factors. So that was the question you asked me yesterday. I said I was going to talk about it more, during this presentation today. So I'll break it down for you. But it's overall, the bigger picture is sustainability report. What we're trying to do at this session today is to speak to environmental, social, and governance factor. But if you then say sustainability report, there is an economic aspect of that. But all of that has to do with both performance and objectives that have been set for an organization, and now the organization has met those performance. That's why you hear people talk about net zero and their target dates. And that's why you hear organizations like ISSB, International Sustainability Standards Board of the IFRS Foundation, talking about the baseline. And we're going to talk about all of that in the course of presentation. And I'm sure that by the time Grace comes out with the second part of the presentation, she makes it a bit clearer to you. So Sheon, if that's answer your question, I will see explain further in my subsequent slide. So you need to also understand sustainability vis-a-vis other forms of reporting. So when you talk about sustainability reporting, it is not just ESG alone. There is ESG reporting on one side. There is financial reporting on the other side. Now we have corporate social responsibility, which forms, as you can see on my slide, I call it a small part of sustainability reporting. So when a company does CSR reporting, it's not the same as sustainability reporting. As a matter of fact, sustainability reporting is bigger than all of them. All right, so here is how I have tried to break it down for you. Let me start with ESG reporting. Like I said, it's a part of sustainability reporting. First, it's environmental, social, and governance reporting, and it covers companies' impact in those three areas. This term often used interchangeably with sustainability assesses, however, it's widely accepted that while ESG reporting focuses on helping stakeholders to assess companies' performance and risk, sustainability reporting has a wider remit. It's creating a framework to help companies to evolve in response to its environment and report on its action. You know financial reporting, all right? So financial reporting, of course, you know the process of preparing financial statement using IFRS accounting standard. So what I used to tell people is the IFRS foundation we used to know used to stand on one leg, all right? But today, IFRS foundation stands on two legs. There is one leg for IFRS accounting standard. The second leg is on IFRS sustainability reporting standard leg. So we have the IASB setting the IFRS accounting standard. Then we have the ISSB setting the sustainability reporting or disclosure standard that we now have today as IFRS S1 and S2, like most of us know it. So it's totally different from corporate social responsibility. I mean, corporate social responsibility reporting that we also know about CSR reporting. In IFRS accounting standard, right? There's some of the standard that we have that deal with, sustainability issues. Standards like IFRS, IFRS 9, for instance, on financial instruments, IFRS 7 on disclosure of financial instrument issue. We have IFRS 13 on fair value. We have IS 16 that speaks to property, plant, and equipment. We have IS 36 on impairment of assets. We have IS 37 that speaks directly to provisioning that is required, particularly on sustainability issue. We have IS 1 itself. We have IS 12. We have IFRS 17 for the insurance businesses. We have IFRS 16 also for leases. We have IFRS 2 for share-based payment. We have IFRS 19 for employees' benefits. IFRS 15 for revenue from, revenue from contract with customer. Now we have IFRS 6 for exploration and evaluation assets as well. So all of these standards from financial reporting point of view, they've found a way to take care of sustainability issues that affect those standards. And then we have the CSR reporting itself. And CSR reporting is a reporting that reports on business model which companies aim to operate in a way to enhance and rather than degrade society and the environment. CSR is a very small part of sustainability, like I said earlier on, and with sustainability having long-term focus and consideration of a company's impact and on future generations. So when you think sustainability, think about the ability of the current, just like I said in my previous slide, think about the ability of the current world to meet their own need without compromising the ability of the future generation to meet their own need. ESG is part of that reporting. ESG is already embedded in that reporting, but ESG is not synonymous, and it is not exactly the same as sustainability reporting. Okay, so to drive home the point, what I've also done in this slide, because of the question that I said I got prior to this session, is to bring real-world examples, for you to see, to understand better when we say, a sustainability report and ESG generally. So in today's rapidly evolving business landscape, the integration of environmental, social, and governance factors, into corporate values have become very imperative. ESG represents a set of standards that companies adopt to ensure that the activities are sustainable and socially responsible. So this presentation really will explore the alignment of corporate values with ESG factors and underscore the importance of work ethics within those contexts. So that is what I am going to be doing in the course of presentation today. So please, if you have any question, do not hesitate to ask as we progress. I'm more than happy to answer your question. But before then, I also want you to see some live examples. And what I brought to this session is to also let you see how some entities had actually been able to adopt or sort of integrate a sustainability report or ESG generally into their practices. So let's look at Starbucks. I brought two entities today. I brought Starbucks, I brought Volkswagen, right? So let's look at Starbucks. In its 2021 Global Environmental and Social Impact Report, Starbucks says 95% of Starbucks coffees was sourced ethically. Over past 6 years, as part of its 10-year, 100 million free commitment, Starbucks has donated nearly 60 million coffee, all right? If you know what I mean, that's huge, all right? 60 million. Hello, sorry, can you hear me? Hello?
We can now hear you. You went off for a minute.
Apologies, I just noticed that the network went off a bit. Just want to be sure you can hear me. So I don't know what you had last, but over the past 6 years, as part of its 10-year, 100 million free commitment, Starbucks has donated nearly 60 million coffee trees to farmers. 60 million coffee trees have been donated to farmers. The company has scaled its full share food donation program to 100% of company-operated stores in the US and Canada, resulting in about 10.4 million meals donated and 13.8 million pounds of food diverted from waste streams. In their 2021 financial year and financial statement, Starbucks once again maintained 100% pay equity for women and men and people of all races performing similar work in the US. It also hired more than 7,700 veterans and military spouses compared to a goal. They set a goal of 5,000 for themselves annually, but they achieved over 7,700. So they're exceeding that goal that they have set for themselves. In the US and Europe, 100% of shelled egg are certified cage-free. So in their financial year-end report of 2021, Starbucks received what we call the Good Egg Award, also demonstrating that they are, doing a sustainable business. In its financial report, right? In the sustainability report, they call it Global Environmental and Social Impact Report. That's how they have christened their own. They have said that in 2030, they have an environmental goal to cut carbon, water, waste, footprints, all of those. They promise that they will cut it by half by 2030. And they have chosen 2019 as their baseline year. So that's an example of how companies are beginning to make huge commitment in their sustainability journey. Right? So that's a good example. It's also good to look at bad example, right? So Volkswagen was a bad example. It's a listed company, one of the best performer in the DAX, the German the blue chip index, until Dieselgate in 2015. You know the issue of Volkswagen and Dieselgate. It was a significant example of how sustainable reporting and corporate disclosure can be at odds with the actual practice. So before the scandal, Volkswagen Sustainability Report and Public Communication portrayed that the company is an environmentally responsible car manufacturer, emphasizing commitment to sustainability, innovation in green technology and low-emission vehicles. However, these claims were proven very, very untrue when the U.S. Environmental Protection Agency discovered the defeat devices in its diesel engine to detect when they were tested for emission that there'd been a lot of manipulation, on the performances. Okay, so Volkswagen, Starbucks are very, very far away from us. Let's come back to Africa. So in Africa, for instance, there is a South African company called Sasol. So that Sasol Limited also had their own sustainability reports that they issued in 2023. In their own report, they said our approach is that we have applied an advanced level reporting criteria of the UNGC meeting the 21 advanced criteria as part of our reporting framework. And as part of our commitment to advancing water management, we are signatory to UN Global Compact CEO water mandate and have adopted a mandate water sewage framework in responding to water risk. Several SASO policies and procedures have been developed and implemented in keeping with our commitment to the 10 principles of the UNGC. So these principles are listed below: code of conduct, human rights policy, human rights framework, supplier code of conduct, security policy, safety, health, and environment policy, anti-bribery policy, gift, entertainment, hospitality policy, and whistleblowing policy. So this is just to show you how entities are beginning to embrace ESG. All right. So, and also to let you know that world over today, investors almost everywhere, they evaluate how companies perform in areas that are critical to sustainability. In fact, there are a lot of funds, around the world today that are chasing sustainable businesses everywhere. So this is a time that even if you run a small enterprise, make sure it is sustainable. And if you do that, capital will be chasing you as opposed to you looking for capital. All right. So having said that tone, I'll use the next couple of minutes to speak around ESG and work ethics, like I said. So it's important for me, I need to also make it clear that when we talk about the way to understand ESG, all right, it is important to see them as criteria that are used by investors today to evaluate how companies perform in areas that are critical to sustainability and ethical operation. So environmental factors include companies' impact on the planet, such as the company's carbon footprint, waste management practices, and resource conservation efforts. Social factors pertaining to how companies manage relationship with employees are very important. Suppliers, stakeholders generally, customers, communities, labor practices, diversity issues. I spoke about recently we celebrated International Women's Day. That's very, very important in the world today, in the world that we live in today. And I always jokingly tell my colleagues that this is the best time to be a woman because there's a lot of opportunity that is going around diversity conversation today. Community engagement, environmental factors, government factors that involve leadership, executive pay, something like audit, internal control issues, shareholders' rights, they are all coming under the governance. So when you hear ESG, it actually means that there are environmental factors, there are social factors, and there are governance factors. And those factors, what every entity is doing is to pick all of those factors and decide what they want to do about the set performance objective and target for themselves and work towards meeting those objectives from the baseline that they have set. So on environment, for instance, you can look at your impact on planet. And so, for instance, personally, in my own home, what I've done is I've had about some, 26, PV panels on my roof in my house. And I said to myself, so I need to reduce my carbon emission. So when there is no NEPA, what do I need to do to ensure that I also contribute to the environment by having a sustainable environment? And so those solar, I got an inverter, 30 kVA that can power mostly what I need the most. So I won't have to use my diesel generator all the time. And so as I've been able to internalize it in my home, entities are beginning to internalize all of those in their own operations as well and see how those impacts can be measured and seeing their own carbon footprint and how they've been able to manage waste and how they've been able to conserve resources within their environment and the effort they are putting in place to even do better than they have been doing before. So social factors like relationship with employees are also very important. So you see most companies today, and when some of us were looking for a job many years ago, I remember over 2 decades, almost 3 decades ago, when I was looking for my first job, it was my employer asking me some certain questions, right? But today, if I'm joining an organization, I'm the one asking them questions around work-life balance. Do you guys allow me to work from home? Do you have policy around, work-life balance? Those are becoming very critical and important questions today that the employers are beginning to get from employees. The same thing has been, asking around governance issue. Executive pay is becoming very, very important. How much do you pay this executive? How much is the cost? What we call agency cost. How much does it cost us? If I want to invest in a company A versus company B, what is the agency cost that company A is paying versus agency cost of company B? What are the issues around governance structure, the internal audit arrangement, the controls they have in the environment, shares that their shareholders have, and all of that? They are beginning to become very important today. And that leads us to the importance of work ethics in workplace. So what I've done here is also to sort of emphasize the need for us to understand work ethics within the corporate context. So I speak to core value of work ethics. Work ethics are grounded in fundamental values like hard work. Every employer expects his employee to be very hardworking, diligent, and dedication to duty is very, very important. They expect them to be professional. Professionalism is very vital in corporate environment, and that promotes a respectful and a very productive workplace. But it's becoming vice versa. Employees are looking at a mutually beneficial relationship between themselves and the employee. At the employer at the same time. So integrity and accountability issue is also very, very important. So employees must demonstrate integrity and accountability to foster trust and collaboration within the team. So in workplace, just like I said, people will prefer to work in a place that got a very strong governance structure, because good governance is very crucial to maintain its transparency and accountability within the company. And ethical work practices reinforces that governance standard by ensuring that decisions are made fairly and in the best interest of all stakeholders, not just of shareholders alone. So again, there's a concept of stakeholders that has come into this conversation, right? So Professor Freeman, for instance, one American professor in 1984, has defined a stakeholder as any person or group of persons that can affect or can have been affected by the achievement of the organizational objective. So if I'm a stakeholder, then it means the organization achieving its objective, I can affect it, or achieving its objective can affect me one way or the other. All right, so that sort of reinforced governance standard by ensuring that decisions are made fairly and in the best interest of all stakeholders. Companies that prioritize governance are more likely to gain the trust of investors and public, and that is thereby enhancing their reputation and, of course, long-term viability. So there's an interconnection between ESG and work ethics. It will enhance corporate culture. Strong work ethic contributes to positive corporate culture that supports ESG initiative and fosters collaboration. So how do you drive ESG initiative? You can always drive it by work ethics. Look at the example I gave in Volkswagen. Definitely somebody somewhere is aware that the company was lying about their emission rate. But look at the example at Starbucks. Everybody in the organization is committed to doing that. Look at Sasol example. It's a well-written culture. Everybody is working towards ensuring that we do the right thing when it comes to ESG. And that is how organization can begin to drive, ESG initiative through work ethics. And work ethics can drive the implementation of ESG initiative, and you can reflect on organization's commitment to sustainability and social responsibility all the time. So it requires leadership commitment. Senior management must demonstrate a commitment to ESG principles by setting clear goals and, of course, leading by example. Employees' engagement is very critical. Encourage employees to participate in sustainability initiative. I used to work in a multinational company that even years after I've left them, some of the sustainability issues that I learned when I was there went with me, to the point that even in my entire household, including my extended family, they know that there are some certain things you don't do. Things like you don't waste water. Things like you don't waste energy. All right? And I learned that from the organization I used to work for. All right. And so, for instance, that organization, for instance, is one of our manufacturing plants somewhere in Agbara in Ogun State. We created a water, a water treatment plant so that all the waters that are coming out of the factory are treated before they were released into the ecosystem. It was a conscious effort, it was a deliberate effort to ensure that that habit is imbibed in all of us as even staff. And so many times we actually did some staff training to ensure that we carry that away from us. And that is how you can put all of that into the culture of the organization. So, ladies and gentlemen, I've got 1 minute more, and I hope that in that 1 minute, I will be able to convince you that sustainable practice and resource management is very key to ESG. Sustainability means meeting the current need without jeopardizing the ability of the future generation to meet theirs. I've explained that earlier on. Resource management is very important. Effective resource management ensures that natural resources are preserved and utilized wisely for future use. And of course, you cannot overemphasize long-term sustainability. It requires a balance between economic growth, environmental health, and social equity. And finally, we need to also be very conscious about reducing our carbon footprint and environmental impact using cleaner technology by engaging in sustainable practices and having consumer brand loyalty programs. So yeah, I've explained all of this earlier on, and I think that what I've said now will make some sense. I just want to, explain just in 2 minutes or 1 more minute to go, the corporate initiative for some environmental conservation that I think is also important for us to mention. Reforestation effort is very important. Waste reduction strategy and water conservation program. I used to also work for a company where we're very big on water. We believe water was a limited resources, even though in Nigeria, you can literally just dig a well or a bowl in your house and start using it, but we shouldn't lose the fact that elsewhere in the world it's not always like that. So I spoke to diversity, inclusion in workplace. It's very, very important. And it's also important that we also bring into very important limelight employees' rights, their safety and well-being. By the time we do all of this, we would have been able to successfully integrate ESG into the organization's activities. Community engagement and social impact is also very important. Volunteerism is important. They say volunteerism is essential for fostering community spirit and creating lasting social impact through collaboration and support. Of course, there are a lot of charitable, initiatives that companies are already doing. Transparency and accountability is very key. If we think about the story of Volkswagen, it wasn't a palatable one. They suffer a lot of, should I say, market punish that bad behavior. And so it's important to also know that ethical decision making and compliance are very, very important. So things like corporate integrity is key. All right, there's importance of compliance is very, very germane. You must always comply, especially in jurisdictions where there are rules and regulations around ESG practices. And of course, ensuring fair practices through ethical decision making will foster a positive work culture and enable overall business performance at the end of the day. You also need to build trust with other stakeholders and align your corporate value, more importantly, with your ESG factors. And if you do that, gives you more competitive advantage, leadership commitment, and some thoughts around that. And of course, you're able to manage your reporting and performance and ESG performance issue as an organization. So in conclusion, ladies and gentlemen, so we don't take a lot of our time, I've been able to show you the importance of ESG alignment. You need to align corporate values with ESG factor. This is very crucial for companies, and you must ensure that you continue engaging in sustainable business practices. It gives company and it enhances the company's reputation. And of course, it also gives some positive societal impact on the organization. It is on this note that I would like to end my presentation at this point. Thank you so much, and I will hand over back to Madam Chairlady. Thank you.
Wow. This is awesome. I can even see all the accolades going up. All the hands are being put together. Thank you, thank you, thank you. This has been really, really great. I think we would, can you please just note down your questions, and you can even type them in the chat room so that we take the second presentation, then we then go into a question and answer session all together for the two presenters. And so, Mr. Ashonke, can you please quickly take the citation for the second presenter? Thank you.
Okay, ma. All right. I'll do justice to that. Let me share this hard citation. This is a very short one, and I love it. Grace Fatugbe is a sustainability reporting leader based in Nigeria with over 20 years of experience in the financial sector. She currently serves on the following boards and committees. Member, IFRS Taxonomy Consultative Group. Member, Nigeria Adoption Readiness Working Group for Sustainability Reporting. Board member, Corporate Reporting Board of the Institute of Chartered Accountants of Nigeria, ICAN. She's a distinguished member of professional bodies, including Fellow, Institute of Chartered Accountants of Nigeria, and a certified project management practitioner. She holds an MSc Finance and Management from Cranfield University, UK. The MSc was financed by the British government under the Chevening Scholarship that targeted exceptionally talented candidates. Wow. So that's a very brief one. Madam Grace, I yield the floor. You can do justice to your paper. Thank you very much. Madam Grace, are you there? Just a moment. Let me try and reach out to her on phone. She might be having network challenges. Let me find out what happens.
Okay. So maybe while we're doing that, I see a question in the chat room already. So Mr. Bironke, maybe we can just take this question while we're waiting for Madam Grace so we don't lose time. The question says, thank you for the presentation, sir. How can one comply with ESG reporting like community engagement and the costs not fall into disallowable expense? Yeah.
This is a practical question, and I know where this is coming from. So, because I've been many times been in this kind of dilemma as well. Sometimes when you want to get approval from your board to say some certain expenses be done from ESG's point of view, and you are not able to back it up from taxation's point of view. So what I try to do, I'm just sharing personal experience, Mr. Adeyemi. What I try to do is to ensure that I do the right thing and I do it and take the maximum advantage. So there is no law that says your ESG activity or corporate social responsibility activity must be to any particular organization. But there are organizations within what we call Schedule 6 of CITA, Companies Income Tax Act. So what I try to do at all times is when the business people come to me in finance to say they want to do some activities, I check those Schedule 6 lists rather, to be sure that the entities they want to do CSR activities will fall within those categories where I can get tax benefit for. And that is what I always recommend that they do. Most of the time, for some strategic reasons, the business people might decide to go elsewhere, right? That is outside of the schedule. What I then do at that point is to put my foot down to say, as a CFO, okay, I would really want us to stay within. All right.
Hi, Ibironke. I'm back. Sorry, I was having some connectivity issues. Can you confirm you can hear me?
Yes, we can hear you, Grace. Go
I
ahead.
can hear you. Let him just finish the response to the question, and then you then take on from there. It's
Okay.
about
Oh,
rounding
okay.
up.
Okay. Apologies. Please go ahead,
No problem.
Ibironke.
All right. So, Adeyemi, so if you can hear me, Mr. Adeyemi, what I'm saying to you is really, I would really stick to those numbers. But if for some strategic reason, the business people want to go outside of that list, I let them know the implication. I let the business know the implication upfront to say, hey, there is no tax advantage for this. If you have gone for ABCD organization, there would have been 32% tax advantage that will gain. And then if the business decide that is the way to go, really as a finance person, there's really nothing you can do to stop the business if they want to do that. But let them know the implication. That's what I always do. I hope that helps. There is a saying, one of my elderly friends from the East, he used to tell me all the time, I'm sure he's on this call too. He says that if the whole community sends away a particular madman from the village, and everybody in the community knows that they were all involved in that decision taking, it's not a problem. But if only you now decide to do that without the binding of the entire community, then it becomes a problem. So what I try to do in finance, as a finance CFO of many years, is carry the business along to say, this is the implication of what we're going to do. From tax perspective, we're going to be losing X amount. If we have gone for option A, B, C, D, we're going to have this advantage. And if the business decides and everybody aligns to that, then that's what you do. So there's really nothing as a finance person you can do if the business, for some strategic reason, want to go that route in terms of community engagement. And of course, there are also some existential threat that can also bring to the organization. So you have to have those considerations before making final call on that kind of decision. I hope I'm able to help Mr. Adeyemi Oyedeji. Thank you.
Thank you so much, sir. So I think we're back to our second presenter. Madam Grace Fatube, please go ahead. Thank you very much.
Okay, thank you so much, Tomi, and apologies for the connectivity issues. So I'll just share my slides. Please confirm you can see my slides.
Yes, we can.
All right, thank you. Good morning, ladies and gentlemen, and it's a pleasure to be here with you all today. I'd like to extend a huge thank you to the chairman of the Sustainability and ESG faculty of our great institute, the Institute of Chartered Accountants of Nigeria. Tomi, it's a pleasure thank you so much for extending this invitation to me. And I would also like to thank everyone who is here today, because if you're not here, then we wouldn't be here. Babajide Ibironke, thank you so much for the really insightful presentation regarding ESG and work ethics. I'll build on what you've already done, and I would want to talk about ESG in Nigeria and how we're keeping pace with global trends. So my presentation has 4 items. I'll start off by defining some key terms, some of which Ibironke has already defined, but I will just reiterate them. There's nothing wrong in hearing something more than once. It just means that it sticks better. After defining the key terms, I'll move on to look at some global ESG trends, then come back to where we are in Nigeria and discuss Nigeria's ESG landscape. And then I'll take a case study and we will then take questions. If you have any questions, please drop them in the chat box at the end of the presentation. I would answer the questions. So the first key term I would like to define is sustainability. I love to define things from their root word. Sustainability comes from the root word sustain, which is an English word. And the Cambridge Dictionary defines sustainability as allowing something to continue for a period of time. Doesn't that sound familiar? Does that definition sound familiar to us? Allowing something to continue for a period of time. Does it sound like the going concern concept? If you agree with me, please type in a yes in the chat box. Excellent, excellent. Yes, the root word for sustainability is actually very similar to a fundamental concept in accounting, which is the going concern concept. And going concern simply means that it assumes that a business will continue to operate indefinitely without any intention or necessity to liquidate or cease operations. And that is exactly what sustainability is also talking about. Sustainability is looking at the ability of businesses to maintain themselves over time, balancing their economic, that is the profit motive, with their impact on social and environmental demands to ensure that they continue to exist for a foreseeable future. So the concept of sustainability, when we juxtapose it with the going concern concept, it's not such a strange phenomenon to us as chartered accountants. But let's now look at the dimension of the items that make up sustainability. We've all heard of the term ESG, and Ibironke did an excellent work trying to explain what ESG is to us. So what I'll try to do is let us look at each of this dimension and then see how we can relate them to our everyday activities as finance professionals. I'll start off with the E, which is environmental. When we're looking at the environmental dimension, what we're simply saying is that as an organization, we have the objective to make profits, but some of the resources that we need to be able to make that profit objective, to be able to meet that profit objective, are things that are naturally occurring. They are natural resources. How are we using these natural resources to ensure that if our organization is in existence in 1,000 years' time, those resources are still available for that organization in 1,000 years' time to be able to continue to produce whatever it is producing? So the environmental dimension is just focused on looking at how the activities of a business can either affect the nature either positively or negatively. And when we're talking about nature, we're looking at things like water, which Ibironke mentioned extensively, the air we breathe in, the trees, the plants, the animals that are in existence. Is our activity harmful to them, or are we carrying out our activities in a way that we're not destroying the earth? Because as it is right now, the only planet where human existence can survive is the earth. And if we destroy it, then it means that there will be no earth where future humans would survive. So that's the environmental dimension. Another dimension is the social dimension. And when we're looking at the social dimension, we're looking at both human interactions. So we're looking at both internal and external interactions. The organization where you work with, how are you treating your employees? How are you treating your customers? The community where you even operate, how are you treating them? Are you handling your interactions with human beings in a manner that is not harmful to them? We now have a young generation in the workforce. And the things that matter to them is actually totally different from the things that mattered to us when we started working. 20 years ago, when I joined KPMG, I started my career with KPMG. And what a young person moving into the professional services firm will be looking at right now will be totally different from what I was looking out for when I joined the career. In fact, one of the Big Four's office in Luxembourg, I saw their advert on Instagram and I was like, really? They were advertising for people to come and work with them. And what they were using as the adverts were showing that they have a sleeping pod. They had things that would appeal to Gen Z. When I joined KPMG, nobody would have used an advert telling me that there's a bed for me to sleep when I'm tired from working. So it tells you that what young people are interested in is totally different from what we have always known. And if you don't take cognizance of their needs, then you would lose them to your competitors that are providing those things for them. And we know that human capital is absolutely, absolutely important to every organization. You can repeat that same process for your customers. If you're not treating your customers in a manner that is helpful to them, you label things wrongly, you claim things that you're not able to deliver, it wouldn't take long for them to leave you and go to another supplier. So we need to begin to look beyond just the profit motive and balancing it with our impact on the environment and how we treat people. And then finally, governance. Governance is concerned about the systems, the processes, the policies, the direction, how an organization is managed. We can imagine that if something is not managed properly, it wouldn't take long for it to either get completely destroyed or disappear. So governance is concerned about things about, are there oversight functions over the activities of this business? Are there internal controls? Are there checks and balances to make sure that things are done the right way and things are happening the way they ought to do? So these are the key terms that I'll be revolving around during my entire presentation. Could you please type in a yes in your chat box if you can still hear me, so that I'm sure I'm still here, because I seem to be having network challenges. I'm actually outside my post in Calabar right now on a project. Oh, thank you so much for the confirmation that you can hear me. So let's now look at some global ESG trends. I'll start off with climate change and carbon neutrality. Climate change seems to be one of the most talked about issues, and some people might wonder, why are they really disturbing our eardrums with the concept of climate change, blah, 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 blah. The truth is that climate change is actually having an impact on several organizations and businesses. I would use a dimension that will make it very clear, and then we can see the impact. For instance, when I was growing up, I knew that rains in the north, I'm a northerner, I'm from Borno State, it's my husband that is from Ekiti, hence the Fatogbe name. I knew that latest by September, it would stop raining in the north. However, in Abuja 2 years ago, it was raining heavily in November. To most people, apart from the inconvenience of the rain, they wouldn't think twice about it. But it actually has a significant impact on a lot of things. And one of those things it has an impact on is that at that time in November, grains would have been stored. They are dried and expected to remain dry so that they can be in good condition. That rain coming in November means that the moisture content in the air would have increased, and it will impact those grains. The moisture content will increase and they will spoil. How does that concern you and I? It means that there will be less grains to be sold in the market, and that will push up the prices of goods and services, which will be reflected in inflation. And every other supplier would now reflect those costs in their production. Let's even take a manufacturing company, maybe a Nigerian breweries that relies on sorghum to manufacture the drinks you're used to. It means that there's less sorghum for Nigerian breweries to use in its manufacturing process, and the prices of its goods will go up. So those are how climate change are impacting us. We now see floods destroying goods and properties. We now even have in the Northeast, we now have like desertification. There isn't even water, there's drought. Things are not able to grow the way they are supposed to grow. So we begin to see that these things are actually having an impact on us here in Nigeria, even though we're not a heavy emitter of greenhouse gases, but we're suffering the impact. And then another concept that is very common globally is carbon neutrality, or net zero, as you may have heard it called. What that simply means is that for the amount of greenhouse gases I have emitted, I should have a mechanism to also remove that content of greenhouse gases from the atmosphere. There are 6 greenhouse gases recognized by the Kyoto Protocol. Methane is one of them, and methane is released when cows belch or when they have flatulence. So it means that if you feed your cows certain kind of food, they would emit more methane. than if you feed them other types of food. So it means that what we need to begin to do as if I'm a farmer and I own a ranch, for me to be at a carbon neutral stage is that if my cows are releasing methane, I should have either a nature-based solution or a technological-based solution to remove that methane, that quantity of methane released by my cows from the atmosphere. The nature-based solutions would be maybe planting trees, because trees take in carbon dioxide and they release oxygen. The technological-based solution, an example would be there are artificial trees that are mechanical trees that take in carbon dioxide from the atmosphere. So there are a number of technological solutions. A number of them are still at developmental stages and they've not yet been scaled up. But the concept of net zero simply means that whatever greenhouse gases you have emitted, try and remove the same quantity out of the atmosphere so that we reduce the impact of warming the earth that is now changing our weather patterns and causing problems for us. So that's one critical global trend around ESG. Another one is human rights and labor practices. Decent work involves employment that is productive and delivers a fair income. So a critical component of human rights and labor practices is ensuring that you treat your employees fairly, as well as the humans within your value chain, your customers, your suppliers. Are you paying them a fair price or are you exploiting them? Are you taking cognizance of people's mental health? You know, the interesting thing is that mental health is not an issue that is really discussed extensively in Nigeria. You see someone flare up and you're wondering, this small thing, and you are flaring up. What is this all about? Not knowing that there might be some other underlying issues. You meet someone, he smiles and laughs at you, and the next minute he's shouting, and you're wondering, where did all of this come from? But once we begin to pay attention to mental health issues, we begin to realize that some of this unreasonable behavior that we're seeing around is because people have underlying issues. And when you address those underlying issues, they're able to live in a better manner with their neighbors, and then you have less frictions even at work. So human rights and labor practices is a very important aspect of ESG that is globally being paid attention to. I'd also like to look at two more global trends. One of them is transparency and accountability. Organizations that are transparent means that they are able to provide information about their activities in an honest way. You may not be 100% good, but that's 50% good that you're doing. You're honest about it. And where your challenges are, you clearly say what your challenges are. Now, transparency and accountability is very important because people invest in businesses based on the information that is available. And if you provide information that is not accurate, and on the basis of that inaccurate information, I extend resources to you, you have eventually made me take a decision that I would ordinarily not have taken had I known the true picture of that organization. There are some people that will know the true picture and still invest in you, but you have given them the true picture and they're able to invest based on what is realistic, as against you just coming up with something that is not true. And a fundamental concept of sustainability reporting simply is the disclosure of your sustainable activities, disclosure of your sustainability related risks and opportunities that are material to your business operations. So sustainability reporting relies on the fact that people are being transparent and providing a true and fair view of their sustainable activities, and they are not greenwashing by falsely claiming things that they are not doing. An example of transparency is Unilever, which adopted integrated reporting where it shows both its financial and non-financial performance metrics, thereby providing a comprehensive view of its progress. And finally, an issue that Ibironke touched on, diversity, equity, and inclusion. For us, this is very important because we all think differently. And each different perspective, when put together, can actually come up with an excellent opinion. So when you have a more diverse workforce, a more diverse board, you're able to benefit from the different ways people think. I am introverted and Ibironke is extroverted. If Ibironke and I are working together, I will see things from the dimension of an introverted person, and he will see things from the dimension of an extroverted person. And when we bring all of this together, we're better able to position our organization to do better because we're looking at a holistic perspective rather than restricting to an introverted version or an extroverted version. And the interesting thing about we humans is that we like to replicate ourselves. I had to make a conscious effort to when I'm interviewing prospective candidates, to ensure that I'm not passing people that are exactly like me. We have an unconscious bias to field towards people that have the same belief systems with us, that behave in the way we behave. So for us to be able to ensure that we have a more diverse workforce and diverse board, it has to be a deliberate effort working towards ensuring that we're bringing people that have different opinions and we're listening to those different opinions to make a difference. And one place where this has been very successful is the banking industry. Over the past 2 decades, the Nigerian banking sector has made a deliberate effort to promote diversity, equity, and inclusion. It started with the Central Bank of Nigeria pushing through the sustainable banking principle that, look, you can't just have an industry where you have only men dominating. Men think in a particular way. Men see things in a particular way. You need to bring upon the angle that will come from a female side of thinking to make sure that you have a robust and resilient banking system. So through regulatory policies, mentorship programs, and institutional initiative, we now currently have about 11 MDs of banks that are female. Now, this is actually very impressive, coming from a period where when I started my career, there was no female CEO in the banking industry to where we have 11. We've come a long way, and then let's celebrate this. And we hope that this would also be replicated across other industries. I'm not saying just put a woman for putting a woman's sake, but within if you have a deliberate effort of mentoring, you will be able to get the women that will do just as good or even better than the men. So even though we've come a long way, I believe that we need to sustain this effort. We need to replicate this across other industries and expand leadership pipelines so that we have a lot more diverse workforce, boards, and executive management, and then Nigeria will be the better for it. So I would now like to go to Nigeria. Let's come back to Nigeria and look at what are we doing in Nigeria as regards ESG. Ibironke has touched on a number of them, and I would like to just build on what Ibironke has done so far. So in Nigeria, we're not new to ESG. That's the interesting thing. For a lot of people who may think ESG is a new word, we actually are not new. In 2004, the Environmental Impact Assessment Act was enacted. And the focus of this act is that wherever your activity is going to have an impact on the environment, you need to do an assessment to understand how those activities will impact the environment. You should have in place a strategy on ensuring that those impacts are not excessive or do not totally destroy the ecosystem. Where you cannot prevent it from destroying the ecosystem, at the point when you're exiting that location, you should return it to as natural a state as it was before you started that activity. And the Environmental Impact Assessment Act is currently being managed and administered by the National Environmental Standards and Regulations Enforcement Agency, which was established in 2007. So we see that Nigeria is not totally new to ESG at all. In fact, environmental perspective, since 2004, there has been an act in Nigeria. And for people in certain industries, you will be very conversant with the Environmental Impact Assessment Act, especially those in the oil and gas industry, in manufacturing, even real estate. Before you start anything, it's something you must do. If we have been doing this as expected since 2004, there would have been a profound difference in the way Nigeria is now. But we have a lot of regulation. Sometimes implementation might be totally diverse from the intended, the intention of the act. But it is important to note that we didn't just start the ESG journey today. We've been at it for years and we're improving. In 2012, the Central Bank of Nigeria issued the Nigerian Sustainable Banking Principles along with the Bankers Committee. Now, one will wonder, what is the business of banks, financial institutions with sustainability, with environmental? Okay, yeah, maybe social and governance dimension may be important to them, but what really is their business when it comes to environmental? The reason why there was a push to get the banks involved in sustainability is simply because they provide a very key service, financial intermediary. The belief is that if the people that have the direct impact on the environment are checked by where they get their funding, then they would pay attention to sustainability issues. Have we heard of the term, he who pays the piper dictates the tune? Is that something we've heard? So if you have the money, you are able to guide certain behaviors, certain expectation. And that was what led the Central Bank of Nigeria and the Bankers Committee to come up with the Nigerian Sustainable Banking Principles, that if the money that is to be passed on to the organizations that have a negative impact on the environment is tied to them doing things in a responsible manner, then they will pay attention to it, as opposed to if somebody just stands and says, oh, pay attention to this, pay attention to this. And that's why the central bank came into that foray. Building on what the central bank did, the Nigerian Exchange Limited, which at the time was called the Nigerian Stock Exchange, became a member of the United Nations Sustainable Stock Exchanges Initiative. What this meant was that the Nigerian Exchange also began to push for sustainable practices by membership of its sustainable stock exchanges. So it began to introduce rules and regulations that would encourage listed entities to take into cognizance sustainability. In 2016, we have the Financial Services Regulations Coordinating Committee. This is a committee of all the regulators coming together and issuing the Nigerian Sustainable Finance Principles. So the CBN started in 2012, and then here we have all the regulators, the NICOM, PENCOM, CBN, Financial Reporting Council, now coming to say, we would not just look at only banks. Even the insurance company offers some sort of financial intermediation to these businesses. Even the pension fund, they have huge amounts of money that they are investing. If these people also understand that by virtue of the role they play, they can actually push people to do the right things and act in a responsible manner, then we'll begin to see a change in the behavior of organizations that actually have a direct impact on environmental, social issues. In 2018, the Nigerian Exchange now issued its own disclosure guidelines for listed entities to adopt. 2019, we have the issuance of the Nigerian Code of Corporate Governance by the Financial Reporting Council of Nigeria. Now, even though the code says Nigerian Code of Corporate Governance, embedded in the Nigerian Code of Corporate Governance was a requirement for board and management to take to disclose environmental and social issues. It might not be clear to a lot of people, but if you actually go through the Code of Corporate Governance, it doesn't just focus on corporate governance. It also requires organizations to disclose their environmental and social activities, although the environmental and social dimension within that code is not as robust as that of the governance, but it's important to note that that code was not only looking at corporate governance, it also took cognizance of sustainability as a whole, showing you that the Financial Reporting Council was actually light years ahead of they were in tune with the global trend. Then we had the Securities and Exchange Commission also issuing its own sustainable finance principle for the Nigerian capital market. 2021, we had the Nigerian Climate Change Act signed into law by President Muhammadu Buhari. What does this mean for us as organizations? This act says that both public and private entities would be assigned a carbon budget. That is a carbon amount that they can emit, and there will be no penalty. And then when you exceed that allowable amount of carbon that you can emit, either as a private entity or as a public entity, a penalty sets in, which is known as a carbon tax. That carbon tax is the amount per metric ton of excess carbon emissions above your limit that you will be charged. This act is already in existence, but the National Council on Climate Change has not yet operationalized the giving each entity a carbon budget and then the carbon penalty. But it's important to note that very soon those things will come out, and as organizations, we need to keep this in view and keep monitoring to make sure we're not caught unawares. Because if you exceed your carbon budget, then a penalty would come in, which would eventually have an impact on your bottom line. Then we now have, in 2022, the Financial Reporting Council announced that Nigeria will be adopting the IFRS sustainability standards. In 2023, 26 December 2023, the inaugural sustainability standards by the International Sustainability Standards Board were issued, the IFRS S1 and S2. They were launched in 6 locations globally, and Nigeria was one of the locations where this standard was launched. So what does this mean for us as finance professionals? The IFRS S1 and S2 is effective 1st January 2024. So it means that the standard's effective date is 1st January 2024. Nigeria has already announced, the Financial Reporting Council has already announced we're adopting the IFRS sustainability standards. But the Financial Reporting Council did not use a one-stop measure. It came up with a phased approach for adoption. And within that is phased approach for adoption. The first were the early adopters that adopted it using a period before the effective date. The effective date is 1st January 2024. So the early adopters prepared their sustainability report using the IFRS sustainability standards based on their 2023 performance. You can no longer be an early adopter. And we have 4 early adopters in Nigeria: Access Bank, Fidelity, MTN, Seplat. We are now currently in the phase known as voluntary adoption. Voluntary adoption would run between the accounting year 2024 all the way to 2027. During this period, you're expected to be building capacity ahead of mandatory adoption. You can't just wake up and say, I am a voluntary adopter. There are certain steps you need to take. And the first step is you need to submit to the Financial Reporting Council your board resolution stating you are adopting the IFRS sustainability standards. You need to submit a gap analysis comparing your existing processes and what is required to be in full compliance with the IFRS sustainability standards, and then your implementation plan of how you intend to close that gap. So if you want to be within the early adoption phase, please pay attention to this. You could get the adoption roadmap issued by the Financial Reporting Council. Page 18 clearly enumerates the list of documents you need to submit. So you can't just wake up and say I'm an early adopter without the Financial Reporting Council going through those documentation and clearing you to be an early a voluntary adopter. The voluntary adoption period, there are no mandatory submission to the Financial Reporting Council regarding your sustainability reporting. But if you wish to submit it to them to review and give you feedback, you can go ahead. Then the third phase is the mandatory adoption period. during this period, there's now a regulatory requirement for you to be reporting using the IFRS sustainability standards. For public interest entities, that is 2028 accounting year. For small, medium enterprises is 2030. Yes, you heard me right. SMEs too would be required to report their sustainability information using the IFRS sustainability standard effective 2030. So if you're an SME, don't think you are outside. My advice would be start early so that you build the capacity to be able to report when the mandatory reporting period comes. The interesting thing about the IFRS sustainability standards is it takes cognizance of proportionality. It realizes that not all entities has the same resources available to them and allows you to provide information without undue costs and efforts as you build capacity to do something more complex that addresses the needs of the size and scale of your business operations. And then the final stage is for government entities, those currently reporting using IPSAS, the International Public Sector Accounting Standards. For them, a date has not yet been fixed, and that is because the standard they'll be using has not yet been issued. The IPSAS board issued its climate-related disclosures last year, October, and closed receipt of comments 28 February this year. So we believe that before this year runs out, they would issue the final standard. And it is after they've issued the final standard that the Financial Reporting Council will now take a look at coming up with a timeline for when they would start voluntary adoption and then mandatory adoption. Now, is it everything I decide to report in my sustainability reports that will go? The answer is no. There would be assurance. Assurance is required, and assurance will be required from the third and fourth year of reporting. So if we take MTN, for instance, that has reported its 2023 performance using the IFRS sustainability standard, it means that by 2025, MTN will be required to do limited assurance on all the disclosures in the IFRS S1 and S2, excluding scope 3 emissions. So what are scope 3 emissions? The greenhouse gas, there are 6 greenhouse gases recognized by Kyoto Protocol. We have carbon dioxide, methane, nitrous oxide, etc. For uniformity and ease of reporting, the other 5 greenhouse gases are converted into carbon dioxide. So you're reporting in carbon dioxide equivalents. So if what you're emitting is methane, methane is 23 times, warming impact is 23 times higher than that of carbon dioxide. There's a formula that you use to convert it to carbon dioxide. But all your emissions are not coming from one source, and they are classified into 3 sources. You have your scope 1 emissions, scope 2 emissions, and scope 3 emissions. Your scope 1 emissions are the emissions that are coming from your direct operations. So for instance, if you're a manufacturing company and you have a plant that is powered by gas or diesel, the emissions that are arising by combustion of that equipment, converting gas into energy or converting diesel into energy, will form your scope 1 emissions because you own that plant and you're using it for your production. If you are a service company and, for instance, you own motor vehicles, as a business, you own the motor vehicles that are used by your employees to and fro for the business of the organization, the emissions from those motor vehicles will fall under your scope 1 emissions. So scope 1 emissions are emissions coming from equipment owned by the business. Then we have scope 2 emissions. Scope 2 emissions are the emissions that you'll be getting from where Ibironke used to work. So the electricity that you purchase, not the electricity you generate. So if you have a generator that is generating electricity for you, that will fall under your scope 1. But if you buy electricity from Abuja Electricity Distribution Company, that will form your scope 2 emissions. So the electricity you are buying from that, you are going to be reporting it as your scope 2 emissions. And then finally, scope 3 emissions. Your scope 3 emissions are the emissions that are within your value chain. So for instance, the air flight, business travels, the commuting to and fro work of your employees, that will come under your scope 3 emissions, and the emissions of your suppliers, the people supplying you with goods and services. And for banks, insurance companies, and asset management firms, they are financed emissions. So what are financed emissions? Financed emissions are the emissions from the people you have financed. For a commercial bank, the people you have given loans to, their emissions will be reported under your financed emissions. For insurance company, the people they have insured, as well as where they have invested their money. For asset management, where they have invested, the businesses where they have invested their money, they'll be reporting those people's emissions. Now, do we see the wisdom of the Financial Reporting Council of putting in SMEs when it comes to sustainability reporting? It's because of scope 3, because most of the things you'll be reporting under scope 3 are not under your direct control. They are from people within your value chain. And if those people do not even understand what data to collate, how then would they provide it for you to be able to report? Then in the 5th year of reporting, you would be required to do reasonable assurance for your scope 1 and scope 2 disclosures, excluding scope 3. In the 5th year, scope 3 will be limited assurance. And then finally, in the 6th year, you would be required to do reasonable assurance for all disclosures. So what standard would you be using for the assurance? Would you be using the International Standard on Sustainability Assurance 5000? It was approved last year. It was issued November last year, and they are currently issuing guidance and applications material. So for us as finance professionals, we're best suited to be able to carry out the assurance of sustainability information because we have several years of doing assurance, but you cannot assure what you don't understand. You need somebody who is a subject matter expert when it comes to environmental dimension. Do we understand what carbon emissions are? Do we understand how to calculate it? Is it a skill we want to learn? Yes, you should learn. But if it's not a skill that you have, then it means that you need to collaborate with people that have that expertise. And you begin to position yourself. So I would admonish each of us to pick this standard, read it, internalize it, and understand it. And so that when the period of assurance becomes effective, we already have the skills to be able to assure. Even though assurance doesn't start until the 3rd, it's not mandated by Financial Reporting Council until the 3rd and 5th year of reporting. It's important to note that nothing stops organizations from assuring their sustainability information right now. In fact, a number of organizations do limited assurance. So if as a finance professional, you don't have the skills to do the assurance, that's business you'll be losing. So we need to have that and keep that at the back of our mind. So I'd now like to look at a case study. And the idea behind this case study essentially is to look at, should everybody just jump up and rush into full ESG adoption without assessing the risk and their readiness for adoption? What could possibly go wrong if sustainability policies are enforced without proper planning? That's what this case study will seek to do. I want us to look at the case of Sri Lanka. In April 2021, Sri Lankan government banned the importation and use of chemical fertilizers and pesticide. It wanted to transition to 100% organic farming. There are extensive research showing that chemical fertilizers actually destroys the biodiversity in the soil, the worms that all those things we see in the soil that we think are irritants actually have a role that they are playing. The worm actually, by going through the soil, aerates the soil for it to be able to get more nutrients. And so in their desire to address all the issue related to chemical fertilizer, they took a decision that they were going to ban chemical fertilizer. Now, why did they ban chemical fertilizer? They wanted to improve the soil health. If you have good soil health, it means that it will produce a lot more food and healthier food, not food that is already infuriated with pesticides. I don't know if we've heard of our food exported from Nigeria being banned in Europe because it has heavy pesticides or chemicals. Has anybody ever come across that that report? If you have, please type yes in the chat box. Have we ever seen anything like that, that we're exporting? Yes, Ayobami. Yes, John. Yes, yes. Now, it's not as if the farmers carry the crops and pour pesticides on it. That's not what actually happens. It is at the point of cultivation. Those pesticides are put to prevent pests from destroying the crops. And somehow it gets into the plant because the pesticide eventually goes into the soil. The plants take the nutrients along with those pesticides and then eventually produce food that contains those pesticides. And that is, so if you have a government that says, oh, I want to go to organic agriculture so that the food that is coming from my country does not contain any pesticide and people would appreciate it and be willing to pay premium money, there's actually nothing wrong with that. So what the government wanted to do was good. It wanted to improve soil health. It wanted to reduce environmental pollution. Apart from those pesticides getting into the crops itself, by the time rain comes, it washes it and it goes into the rivers where most of us get water from, or even most of us, just like Ibironke mentioned. Ibironke, that's your analogy of just digging a little while and getting water. Only applies to you people in the south. Too. In the north, you dig, you won't see that water, but that's by the side. That pesticide also seeps down and gets into the water that you are drilling as borehole and using in your houses. And it has impact on food safety and on our health. So if we look at what the government was trying to do, was it something good or bad that they wanted to promote soil health and reduce environmental pollution? Is that something that is good or is it bad? Please type your answers into the chat box. If you think it's a good thing, just say yes, good, excellent, at Antonia. Yes, Ismail, excellent. So it was a good thing. But even when you have good intention, things can still go wrong. So how did they implement it? They started with an immediate enforcement of the ban without a gradual transition period. Even though they started with an immediate ban, they didn't have enough organic fertilizers to replace the chemical ones. So can anybody guess what would happen in that scenario? You have said people should not use chemical fertilizer. And then there was insufficient organic fertilizer. Can we guess what would happen? Please put your answer in the chat box. Will everything go right or will things go wrong? You don't have enough organic fertilizer and you have banned chemical fertilizer. Scarcity, excellent, Ayobami, yes. Ayobami, I think you can take up the good gone wrong is chaotic, excellent, excellent. So that was exactly what happened in Sri Lanka. From a country that was food sufficient, their rice production declined, that they now had to import over $450 billion worth of rice to feed themselves. This was a country that was exporting. Everybody in Sri Lanka that wanted to eat rice could buy the rice and eat it, and there was still excess to export. With that singular decision, they changed from being self-sufficient to importing. Apart from rice, another thing Sri Lanka is known for is tea. What happened was they suffered significant losses, leading to about a loss of $425 million in yields for people working in the tea industry. Imagine if you had invested your money in a tea business. It means that a lot of your money could have been eroded simply because of a singular decision taken by the government. And what was the impact on the economy? Food prices and inflation skyrocketed. There was a strain on their foreign reserve. In fact, there was a protest that eventually led to the ousting of the leader of that country. That was the only way the public stopped protesting. They went over the presidential villa, overtook it, and were protesting and protesting until the only way out was for him to resign, and then another new government came in. So we can see that even though when you have a good intention, things can go bad. So what I want us as finance professionals to take out of this is that when we go back, we should realize that if you're not already having any sustainable practices within your organization, you should have a gradual transition. Ensure that you understand what you're getting yourself into, and you're implementing it in a manner that will not strain your resources or cause problems for you. And that's one big thing that I appreciate with what the Financial Reporting Council has done. It's adopted a phased approach. Even the early adopters, it didn't force them. They chose to be early adopters. Voluntary adoption is not even forcing you to be within the voluntary adoption. It is in 2028 that mandatory adoption will come in. So we can see that the Financial Reporting Council has actually adopted a gradual transition. When you do a gradual transition, you're able to build the skills, the processes, the policies to support the decision you're making. Another mistake that Sri Lanka made was it didn't have the buy-in of the farmers. It didn't train the farmers. They didn't understand what to be done. They didn't even understand organic practices. So the lessons for us as finance professionals is that as we're going back, we need to carry the entire organization along. People need to understand what this sustainability is about, what this IFRS sustainability standards mean, what does reporting mean, what is required of each person, so that, because the information you'll be reporting will be coming from across the organization. So the people you need information from, you need to give them the support they need to provide the information in the format that you need it. And then do a pilot. They didn't do a pilot program. They just started big bang approach, and the big bang approach led them into a problem. You could do a pilot program. The IFRS sustainability standards actually gives a transition relief that in your first year of adoption, you don't have to report on all your sustainability issues. You don't have to report on entire environmental, social. Just focus on climate-related risks and opportunities. That can be the dimension you want to take. It also gives another transition relief to say in the first year of your adoption, you don't have to report on scope 3 emissions. You can just report on scope 1 and scope 2 emissions because it understands the difficulty and the resources required for you to report on scope 3 emissions. So pick up the IFRS S1, S2 standards and identify the transition reliefs that the standard gives. And as much as possible, when you look at the state where you are and you know that you cannot fully comply, take advantage of those reliefs and build capacity. Another thing that Sri Lanka didn't get right is they didn't do stakeholder management. They didn't involve farmers, agronomists, and industry experts when they were coming up with the policy and decision making. For you, as you go back, carry everyone along. Most information you would need from the social dimension will come from people outside finance, human resources, and your customer service. If you have customer service or corporate communications, because under the social dimension, you're reporting on your internal, your employees, which will come from human capital or human resources, and your external, your customers will come directly from your client-facing business units, and then your communities, that will come from corporate communications. So if you don't carry these people along for them to even understand the data you need and why you need it and when you need it and the format in which you need it, the day of reporting, somebody will send you an epistle that is not correlated with what you need to report. So it's important to carry stakeholders along. And it's important to note that for the IFRS sustainability standards, the dimension and focus is financial materiality. And financial materiality is defined as the same way you find it in paragraph 7 of IAS 1. That is any information where you omit, misstate, or obscure could influence the decision of primary users. And Ibironke eloquently defined primary users as defined by the conceptual framework. These are your existing and potential investors, existing and potential lenders, existing and potential other creditors. So the IFRS sustainability standards only requires the disclosure of sustainability-related risks and opportunities that could influence the decisions of primary users. So you need to identify your stakeholders that can help you in doing your materiality assessment, because it's not every sustainability issue that is material to your organization. You need to do a materiality assessment to identify those. And if you don't carry your stakeholders along, how then do you get their views of what the material issues are for you as a business? And then finally, monitoring and evaluation. You should establish a mechanism to monitor outcomes and adjust your processes and policies based on empirical evidence. So with that, I have come to the end of my presentation, and we will be taking questions. I would hand over, Chairman, Madam Chairman, do I hand back to you, or who is going to moderate the question and answer session?
I will be the one moderating.
Okay, thank you. I hand over back to you, Madam Chairman. Thank you so much.
Thank you so much, Grace. Wow, this has been awesome. I can see all the love notes, all the clapping and everything. It's really, it's like going to Harvard. And people have gotten free training. I can see even my secretariat have put up things, I mean, in terms of being able to get the recording. So please check the chat notes if you are not looking at the chat notes, because the 2 sessions we've had today, they are very powerful. And I'm sure people would really like to even get more and get the recording as well. But without further ado, I'll just go straight into the Q&A session. I have a lot of questions already in the chat room. So I will just quickly go through those ones. I also see a hand raised up, but if you don't mind, let me start with the questions in the chat room. Mr. Ibironke, I hope you are still here. You can also just come in with your camera so that we can see you. The first question, I mean, you had answered, and then there's a follow-on question to that that says, can you list one of the tax benefits of ESG participation to corporate organization in Nigeria? Yeah, so maybe if you can, they didn't direct it to anybody, but I'll just be directing it to each one of you, but we can keep the answers short because we have quite a lot of questions. So Mr. Babajide, if you can answer that, then I'll go to the next question.
So thank you, Madam Chair. And the person is asking for tax advantage of ESG.
Of ESG participation for corporate organization in Nigeria.
So as of now, this is a difficult one because FIRS have not come out to say anything altering Schedule 6 on the list of the items that they will allow for tax purposes on ESG for now. So like I said in my experience earlier on today, what I do is to look at those lists and then advise my organization to say, whatever ESG activity we want to do, we can still do it with this number of approved entities that we have on Schedule 6 and then get our tax benefit from it. The truth of the matter is, whatever you do today, as long as it's not on that list, you won't get tax exempt for it because it's not allowed for tax purposes. However, I also know that very reasonable, and I'm sure most of them have seen about 2 of my colleagues who are on this list, and they also understand what ESG is all about. I also know that you can make a case, very strong case, they can allow it for tax purposes, but it is not on the list. If it is not on the list, it will be difficult, but the burden of proof is on you to be able to convince them that you have actually done that and for tax purposes. That's how I would like to attend to that. Yeah, thank you.
Thank you so much. And if I just add to that as well, like you said, it's not on the list directly today, but indirectly, there are certain things that people can also do. So I remember some years back when some organizations were looking at how to channel their taxes towards improving the infrastructure we have in the country. And so we were able to work with them as KPMG to engage FIRS, and then came up with a policy, an act, whereby some of these organizations, if you then adopt a particular road and you build the road, you spend your money building the road, you get the tax benefit. And that's happening today. And you can see a number of companies. For example, we saw Dangote doing the road leading to the airports, and a number of other companies have actually started doing that. So if there are other things as well, people can actually come together, and there can be engagements with the tax authority. And I'm sure these things will be looked at. Over time, we will get to a situation where some of these things then become more direct. It's still at the nascent stage as we speak today. If I go to the other question, it says, how do we drive compliance of this form of reporting in companies owned by one individual whose idiosyncrasies determine what is practiced in the organization, especially around work ethics? Grace, can you help us with that quickly?
That's a very interesting dimension. So I think if we look at the objective of the IFRS sustainability standards is identifying the issues that are material to your financial performance. So if as a finance professional within that kind of organization, you're able to show that owner, manager, that look, this practices is actually reducing your profitability, he will quickly adjust to the more favorable practices that are actually going to enhance his profitability. So it's you being able to use data and analysis to show that this particular ethical work behavior can increase your performance, your financial performance by XYZ. And then you begin to see them changing, not necessarily because they're interested in the social dimension, but because it will affect their bottom line. Thank you.
Thank you so much for that. There are also, I'll just take 3 other questions online, then I'll go and meet the people that are raising up their hands. There's one other that says, has there been any law in Nigeria making sustainability reporting mandatory for quoted companies in Nigeria? If not, how can one ensure compliance with this? And you can also take that together with how do we avoid greenwashing and ensure transparency in ESG reporting to maintain reputation and trust with stakeholders. Okay. Yeah. So Grace,
thank you so much.
With...
Yeah, thank you so much, Madam Chairman. So yes, there is a law right now. The Financial Reporting Council has announced that mandatory adoption of the IFRS sustainability standards is effective 2030. The public interest entities also covers the listed entities. But before that mandatory adoption period, there are some other regulations that somehow forces listed entities to report on ESG. For instance, I did mention the Nigerian Exchange Limited has a guideline on disclosure regarding ESG. So if you are quoted on the premium board of the Nigerian Exchange right now, there's a requirement for you to report on ESG. But for the IFRS sustainability standard, it becomes effective for all public interest entities, which includes quoted entities 2028. And on the issue of greenwashing, I believe that the requirements of assurance by the Financial Reporting Council will somehow be able to provide some reasonable assurance in the disclosures that entities are making. And then another check would be if I'm in the same industry with a particular company and the company is reporting on certain issues and I'm not seeing it in company B, that already gives me an inquisitive mind to find out why is company B not reporting on these issues. So I think that's another way to check greenwashing.
Yeah, thank you so much. And just even adding on the greenwashing, even the stakeholders are all watching out. We've seen this happen in several jurisdictions. For example, in some jurisdiction, the Lufthansa some years back had this logo of a bird that covers the whole skies, and they were busy saying that they were protecting the planet. And the German authorities looked into this, and they were slammed with fines because you're an airline organization, carbon emission is quite high. How can you then say that you are protecting the skies? And when they looked at their operations, they didn't even see any initiative that they had that relates to having technologies to lower carbon emissions. So the assurance will definitely help to streamline greenwashing. Activities of stakeholders, which we are all part of it, would also help because people will talk when they see that you are not really doing the right thing. Okay, so let me take another question online.
Sorry, Chair.
Yes, please.
if I can
Yeah.
add to the greenwashing conversation, that
Yes, please.
apart from greenwashing, right, there is also the greenwashing side, which is the practice of deliberately downplaying or under-reporting sustainability achievement and initiative by organizations. So there is greenwashing that we know as creative accounting. We also have the greenwashing at the other side of it. It's important that we know that both practices are not allowed under sustainability reporting or ESG reporting. Thank you, Mr. Chairman.
Okay, thank you. I have a question here for you. I'll just take the three of them together. I suppose we've answered it already with this last one, but maybe just to emphasize. So the first question says that does ESG and sustainability principles compliance impact an organization's bottom line, their revenue and profits? Please give examples of an existing organization. We've talked about Volkswagen. I've talked about the airline company. Yeah, and then another question then goes to say that is Nigeria companies ready for ESG reporting? Because most companies in Nigeria are known to tell lies and fabricate it to the extent of convincing you to believe in it. That's far-fetched, actually. So, but I'll leave you to answer that. And then lastly, related to that, I have a question that says that is ESG reporting mandatory for consumer goods firms in Nigeria? And can you clearly distinguish between sustainability reporting and ESG? And then I'll go online. I'll go to the other questions after that. So between both of you, you can.
So maybe I should just give it a shot. And I think, just like you've said, Madam Chair, we've answered this in passing in our presentation. So I've given an example of Starbucks, for instance. And I'm a Yoruba man, and we have a saying that says, when a lie is traveling for 20 years, one day the truth will catch up with it. And that was what happened in the Volkswagen case. And the same case in the airline that you also quoted, Madam Chair. So that people lie, yeah, people will continue to want to do some greenwashing and greenwashing here and there, but somehow with the assurance that has been put in place, of course, you detect those lies, and the market would punish any bad behavior from either greenwashing or greenwashing, for that matter. That's how I like to address that. Thank you, ma'am.
Okay, thank you.
Okay,
Grace, any thoughts?
Yes, so mine is to do with the difference between sustainability and ESG. So sustainability is way broader than ESG. ESG is just a framework for measuring the performance of organization. The pillars for sustainability, Ibirunke mentioned economic, social, and environmental. So yeah, so you're looking at a broader dimension when you're looking at sustainability. So you're looking at both environmental, economic, and social. But then ESG is a framework that you use for measuring the performance of an organization. And sometimes the ESG may not be focused, the ESG is not focused on economic at all. And the IFRS sustainability standards bring the dimension of saying we're not just doing ESG as something that is good to do. This ESG, we're focusing on the parameters of ESG that actually can impact your profitability, your financial performance. So what are the sustainability related risks and opportunities that can affect your cash flows, either positively or negatively, that can impact your cost of capital, either positively or negatively, and your access to finance? So that's the distinction between ESG and sustainability. And on, does this really help organizations? The answer is yes. For instance, we've seen a lot of organizations migrate from using diesel power generator to solar energy. And if you do an analysis, a cost benefit analysis, actually they enjoy a reduction in their expenses by just that transition from using diesel to power their operations to renewable energy. So there is actually some benefit when you use when you use ESG in your businesses. But one thing I want you to note is that it's not every ESG initiative you would adopt. You have to identify the ones that can impact your cash flows, your cost of capital, and your access to finance, either positively or negatively. And if you identify them, they would definitely have an impact on your financial performance. I hope we've been able to address all the questions and we didn't miss any.
Yes, you
yes,
have.
Also add to that energy cost side. That's my forte, Grace. So you're very, very correct. And I need to also stress it for people to understand that in the long run, when you look at the cost of things like solar, putting a solar panel and the storage facility on board versus band A. If you're on band A and you pay 209 today, if I do a tariff derivation for you for over 10 years, depending on your energy consumption, you're better off with renewable energy, especially solar. For instance, because the cost to buy the PV and all of that, they are going to be historical. It's going to be some cost. We're all accountants. And so the increment you will get in your tariff on band A or band B will not be affected by the initial investment you will have today. And if you spread it over 10 years, we have seen that band A today is 209 naira per kilowatt hour. Now, your solar, if you use 6 units in a day versus band A, you are going to be paying around 179 naira versus 209 that you're paying. But it has to be a long term. So it's also, there's a cost saving, cost benefit, apart from environmental benefit that you get. And organizations such as RMI and some other organizations are already working with us on some of those initiatives. So just so you know, there's also cost side to the benefit. Thank you.
Definitely. And I'm a living witness to that in my house. Okay, I see that there's no hand raised up anymore. But let me take the last questions that we have here as we've run out of time as well. So I have henceforth we will be having sustainability report, which encompasses ESG, financial, and CSR reporting. Is it the external auditors that will also issue ESG, CSR reports in the same audit report? So that's one question. There's another question that says that how can a company report an inverter installed for remote employees as part of a sustainability or ESG disclosure? Okay, so I'll take that and I'll take one last set and then that will be all for today. So if you can answer those two.
Okay, so the first one, the external auditor is not required to give an opinion on your sustainability report, except if you have also engaged him to give assurance on the sustainability information. So your audit engagement would need to clearly stipulate that the person is doing 2 engagements. He is giving assurance on your financial statements as well as the sustainability report. You can use the same external auditor, but they have to be 2 different engagements. So there's no requirement for the external auditor to review the sustainability report along with the financial statements if his engagement is just to provide assurance on the financial statements. Then on the second question, Tommy, could you remind me of the second question again? I think it skipped my mind.
Okay, I've just dismissed the question. Let me just check. Oops.
Oh, Ibironke, can you remember it?
Okay, yeah. How can a company report an inverter installed for remote employees?
Yes, okay, excellent. Yeah, thank you so much. Yes. So you remember scope 3 emissions. Ordinarily, your employee will be commuting to and from work, and you would have reported the emissions under your scope 3. By providing inverter for them to work remotely, it means that they are not commuting. So you would be reporting that as part of your reduction in greenhouse gas emissions. So, and then along in your PPE, that inverter will form part of your property, plants, and equipment acquisition. In your sustainability report, you now indicate that the increase, that addition in PPE is to enable you reduce your greenhouse gas emissions and be able to tell us by how much the greenhouse gas emissions have been reduced. Thank you so much.
Thank you.
Yeah. Okay, go ahead. Oh no, I just wanted to also, tell the person that has the question to remember what I said earlier on about the CDSB initiative. Actually, KPMG, maybe Tommy, KPMG did some joint reports with them, supplementary paper that they did, and I will share a copy of that with my presentation so they can have it. It was clearly stated that there are some ISCs that help in measuring this and capturing this and recording this. So Grace had mentioned one of them, that is IS-16. We have IS-1, IS-37, IS-36, IFRS 13 on fair value, IFRS 9 and IFRS 7 on fair value, financial instrument disclosure. And all of those standards actually captured, their revisions now had captured the implication and Climate Disclosure Standard Board, the CDP report, particularly the one that I said they did with KPMG, actually identified those areas. And I think as accountants, we should be interested in such reports. Let's get them, let's read them, and let's internalize them. Just like Grace has said, you can capture the emission that your staff would have used to commute to work versus what they have used to stay back at home, and then use that to report under your scope 3 emission reduction. And that goes a long way in helping. Thank you.
Thank you so much. And the last questions, how is the carbon budget monitored? Also, with respect to IFRS sustainability standard, and when it comes to full implementation and compliance, how do we tackle the fire brigade approach that is becoming a norm in Nigeria? So two separate questions. One is how to monitor carbon budgets. The other one is how to prevent people from doing lastminute.com on IFRS S1 and S2 adoption like we normally do in Nigeria.
I think
So,
the lastminute.com, I will leave that to Ibironke. Ibironke, answer the lastminute.com. Let me answer the monitoring.
In fact, the lastminute.com, it was as if you were in the spirit. I was going to say that Financial Reporting Council had already addressed the lastminute.com. So if anybody is in lastminute.com, that person is not really, is not aware of the work that has gone into that. The Adoption Readiness Working Group had already done a roadmap that would let us avoid this lastminute.com, syndrome that we always have in Nigeria. For instance, we've identified the first-time adopters. They've done their work 2023, and then we have up to 2023 to 2027 for every volunteer adopter to say, okay, you know what, I want to do it. And during that process, during that period, nobody would chase you. Nobody would harass you for any form of non-compliance or mistakes here and there. If I were an organization that want to adopt IFRS S1 and S2, I would start even during that period. You can make your mistake during that period and correct yourself and make sure you get it right before the compulsory adoption stage kicks in. So, and that's 2028, where this is 2025. You have 2026, 2027, another 2028 to begin to get into that. So the lastminute.com in this case should not arise because Financial Reporting Council of Nigeria has factored that in depending on your organization. And that's, we're talking about PIE. There is still a long, a headroom, long, room for compliance for SMEs, for government, business entities, and the rest of them up until I think 2030, and in some cases until the new standard is issued. So I don't think there will be lastminute.com in this approach. And if we can weather the storm of IFRS adoption in 2012, why can't we do that for IFRS S1 and 2? Thank you.
Okay. Thank you so much. Grace?
Thank you. So how do you evaluate, monitor carbon budgets? Now, the responsibility for that is with the National Council on Climate Change. Generally, there are two ways of monitoring carbon emissions. One is using a machine to measure the carbon that has been emitted by an activity. And that is not very common because it's not very reliable. So the second is you do greenhouse gas computations where you pick an activity that is supposed to have generated the emissions. You apply an emissions factor and then you get what would have been emitted. So my expectation is that when the National Council on Climate Change operationalizes the carbon budget, they will be using the calculation method. So typically for the size and scale of businesses and their business model, there's an expectation of where their emissions will be coming from. For instance, if I'm a manufacturing company, my most likely emissions will be coming from my plants or my diesel generators. So it's to identify the amount of fuel or gas I have purchased. Those things will be reported somewhere in your financial statements. And maybe to do an estimation to say, okay, for 1 million liters of diesel that is consumed, this is the quantity of, this is the number of liters of diesel that must have incurred this 1 million naira. And then I multiply the liters of diesel with the emissions factor, and I'm able to say, this is the greenhouse gas emissions from company A. And if they are reporting something lower, definitely as a regulator, I'll be able to pink out that, no, this is not what your emissions are. So you as the entity yourself must be doing your own calculations so that you're able to use evidence to counter any over-exaggerated emissions from the regulator. So that's the way you can monitor the emissions. Thank you very much.
To add to that, Grace, sorry, Madam Chair, and I want to let members also learn more about the SBTI, Science-Based Target. So if you go to sciencebasedtarget.org, you will learn more about how entities can use, science-based target to actually measure some of these things. And there are quite a number of organizations across the globe, like carbon trackers in the UK and everywhere in the world. You can use some of these mechanisms to actually track your carbon.
Hello?
I can hear you. I think he's having network issues.
Okay, no problem. Thank God we've gotten to the end. I mean, just to add to the question on lastminute.com, I remember as I represented KPMG on the adoption working group, and it was a major issue that people were actually thinking through. And that's why we were able to flex the timeline for the adoption of IFRS S1 and S2, because when you look at it, it's quite a lot of work to be done. There's no way you can plan to do lastminute.com. You need to first of all have your strategy. What's your sustainability strategy? Because you can't even start talking about reporting on anything without having your strategy. You need to develop your reporting framework. You need to set up the function that will be overseeing sustainability, both at the board level, management level, the day-to-day activities, working with everybody. The data for sustainability is all across the whole organization. It's not just residing with one party. So there's a lot of work to be done, all the way to measuring your carbon footprint. It's not something you can wake up tomorrow and just say, I've adopted. It doesn't work that way. And that's why the roadmap was actually flexed out. And I will actually like to plead with everybody here for your organization. Please ensure that you are raising this to the governance committee, to the group that matters, so that people can start doing something, because you cannot afford to wait. There will be issues if you decide to wait. It's not something you can do overnight. And on this note, I would like to say a very big thank you to our two wonderful presenters, Babajide Ibironke and Grace Fatogwe. You've been wonderful. You've been excellent. We've learned quite a lot from you today. And I know we are definitely bringing you back. You've made our first webinar excellent. And I know we are coming back to knock on the door with both of you. So thank you so much. I know we've exceeded our time. We will round up over the next 5 to 10 minutes. We just want to take some announcements and then we will do the closing remarks. So Mr. Shoronke, can you quickly give us the announcements and then we can take the closing remarks? Thank you. Thank you,
Madam Chairman, for the energy and coordination. Two major announcements. I've already dropped in the chat box, but I will still talk about it. One, members who are willing to make payment and get 7.5 credit hours, slides, and recording, they are enjoined to make payment to the faculties. We are using this to develop our institute. So once you make that payment, send a proof via an email provided, aks@ican.org.ng. So we'll get it and collate accordingly. Secondly, is the issue of members who wish to join a very fresh and new Sustainability-ESG faculty should also send a request to faculty@ican.org.ng. That will be treated and they will be added to that faculty. You can copy AKS Shoronke at ican.org.ng. So thank you very much, Madam Chairman.
Okay, so thank you very much, everyone, for joining this session today. We appreciate your staying all the way till the end. And we definitely have lots of other things to bring back from the faculty. We are cooking certifications, sessions, we are cooking so many other things, newsletters that we'll be bringing out in this faculty. and just stay tuned, and I'm sure you will deepen your knowledge of sustainability and ESG as we go along. So thank you, and do enjoy the rest of your day today.
Thank you,
Thank you,
Madam
Chairman.
Chairman.
Thank you.
Chairman. Bye-bye,
Thank you.
everyone. Bye.
Bye,
So on behalf of
bye
our
everyone.
president, we say thank you to all the participants and participators. Mr. Ibiloke, thanks for your time. Madam Grace, thanks for your time too. Our participants, you are there because you are here. Thank you very much. We appreciate you all. It's a free program, but they say if you are desirous of getting credit hours, 7.5, you can pay and get it. That's the information we have for you. Unless if you don't want to pay, if I go to our YouTube and download and continue to listen to it at your leisure hours. That's fine. Thank you.
Go.
Bye, everybody.